Let's talk a little bit about the official sector demand in terms of the central banks, because we've seen your latest reports. There's still, what do we see, 8 straight months of central bank buying back to back. Is it slowing down? Where are we going?
It's actually continuing. Here at the Symposium, there's been a lot of talk around this backdrop of what's in front of us in terms of risk and the outlook for both the dollar and dollar assets in terms of how fiat currencies are going to play a role going forward. We just released our annual central bank survey, and that report talks to the fact that nearly half of the central banks surveyed, 73, our largest number ever, are signaling that they're going to increase their allocation to gold. That's up from 29% the year before. So you're having people telling us openly that they're going to be adding more gold to their portfolio at these prices. So it's not about whether or not it's too expensive or not. It's about what it does when you add it. And actually, when you're investing a dollar amount, 3,500 an ounce, 3,200 an ounce is less relevant when you're talking about putting 50 to 100 million to work. You're looking at a dollar exposure to the gold price, which actually will help you over time because they're looking for safety in terms of an asset that performs in crisis. They're looking at diversification that will actually be liquid when they need it. And they're looking at homegrown inflation still as a concern on their part.
Joe, do you view it as a structural shift or a temporary flight to safety? And I know that's a broad question. We're hearing rumors about sovereign wealth funds coming in aggressively. Are pensions and long-term committers finally entering this space?
So our conversations at the pension level are actually as aggressive and more detailed as they've ever been. They do have a lot of hurdles to cross to make a big shift in their portfolio allocations. But we're talking to them about no longer this 1 to 2% allocation. There's an understanding that 5, 7, 10% may be a more realistic number. Now look, there's a lot of work to do to get people to move from where they are to that number. But there's definitely a reception to saying, how do I hedge? Because bonds and equities are highly correlated at this point. That's a structural shift, and that's going to continue to play out. And I think at this point, if cash balances attract less interest, then that money from cash may move to gold. And that's where we'll see the allocations. And then overall, when you're talking about central banks, this move to diversify away from fiat currencies or assets linked to the US, for example, that's definitely a structural shift. There's been a headline, can we trust it or not? I think we can probably believe it, that gold surpassed the euro in terms of a reserve asset right now among central banks. That's a big moment. We're actually looking pretty well positioned to be continued to talk to the central banks and be a component that they're going to talk to for the foreseeable future.